Some investors may have been surprised by the reaction we've seen in the oil markets to the recent U.S. attacks on Iran and Tehran's response. Have markets become a little desensitized to global shocks, the geopolitical scene, or are there other factors at play? Bard Malik, head of commodity strategy at TD Securities, is here to share his thoughts. June isn't over yet, but we've gone from $65 a barrel, $75 a barrel, back down to roughly $65 a barrel, and a lot's been going on. What is happening with the price here?
Well, first of all, it's great to be here, and it's been a very volatile month for oil markets. We went from the lows to highs to almost the lows again, and let's start with what happened, I guess now 12 days ago. We had hostilities between Israel and Iran. That certainly was a catalyst that drove oil prices higher. The big fear, of course, was that we're going to have interruption of crude flows from Gulf states, possibly through the choke point of the Straits of Hormuz, and potentially attacks on infrastructure in Saudi Arabia, even, and other Gulf states, big producers. Just as a note, the Straits of Hormuz, for example, sees about 15 to 17 million barrels of oil flow and petroleum products daily.
Just in a day, wow.
Well, and that's, roughly, give or take, 20% of global supply. While we have spare capacity in the global markets, mainly it's in the OPEC countries. So if we have interruptions in the Middle East, we have no spare capacity, and that would very much hit supply and put this market in a big deficit and send prices sky high. Well, that fear only grew after the United States decided to enter that conflict by attacking nuclear facilities. And we had statements from the government of Iran that they were keen on closing the Straits of Hormuz. Prices moved up. I think most recently one of the highs was 75-ish, 76. But then we saw a big decline. And the question is, one, why did we not see prices jump all the way to $120, $150 a barrel, similar to levels where we've seen after Russia's incursion into Ukraine, which is a valid question. I think for the most part, the market did not believe this was going to escalate. Second, the demand side looked pretty lousy. And for the most part, before the U.S. entered, the market was pricing in potentially more stringent sanctions on Iran as opposed to an interruption. And as it turned out, we didn't have a broad war. Straits of Hormuz are not shuttered. Part of the reason is China was opposed to it. China, has some 40% or so of its oil flow through that strait. So one of potential allies of Iran would have been quite upset. And of course, that would have triggered U.S. military response in a more robust way, directed possibly against the regime. So thankfully, it is de-escalating right now, and we're seeing prices drop, well over $10 to current levels. Still, in our opinion, there is a bit of a risk premium.
Even at these levels, there's still a bit of risk premium.
Absolutely. The market is oversupplied. And ironically, this conflict is probably going to see more oil next year than otherwise. And the reason is some of the marginal producers, particularly in the shale areas in the United States, the Bakken and Permian and so on.
Start pumping more?
Yeah, because they hedged their price forward. Prices spiked. The curve was still, I think, backwardated for the most part, but we had higher prices, and many of them were able to lock in over $65. And $65 seems to be the break-even point where it's economic to drill.
So we've evaded the existential, I think you've called it the existential crisis that didn't happen. We've evaded that. What would it take for us to break that threshold?
to move to the.
We start moving to the upside again. We're
Yeah,
like, I think about how compressed everything gets in terms of time. This was only a couple days ago. This was like Sunday that our team was trying to discuss how are we going to cover all this. We're only at Wednesday, and it's like everything's fine and we've moved on.
It did go extremely quickly.
Yeah.
The existential crisis that didn't happen. I was, pontificating on this very thing on some other shows that, unless there was a disruption, a real disruption of supply, we're not going to see prices move beyond $90. And in fact, that indeed materialized. And that's because demand is weak. China's demand is only growing by 2 million barrels a day this year. We're probably not going to see much strength next year either. And supply is out there. OPEC is increasing supply by 400,000 barrels a day. We could easily see the 2.1 million barrels of voluntary cuts being unwound, and we're going to see a surplus. So the market was always pricing that in, and unless there was evidence, clear evidence, to suggest that the supplies from the region broadly were going to interrupt it, there's very unlikely that prices were going to surge. We've already mentioned oversupply, weak demand.
Let's get into the demand picture here. I mean, what are we looking at on a global basis? Is this because we have these economic worries that take us back to a story we at least haven't talked about for a couple of days, tariffs, trade?
We're sort of on the lower end of consensus about what we think about 600,000 barrels of demand growth this year versus well over 1 million previous years. And China alone was clocking in over 1 million barrels a few years back post-COVID. Next year, we're looking at only maybe 700,000 barrels of demand growth. So China growing 0.2 million barrels. That's nowhere near 1 million, nowhere near 500,000. It's much, much lower. Industrial activity in China, when you look at the Kiaxin and the other PMI indices that are good measures of activity in the manufacturing sector, are all pretty weak. We continue to see in China the transition to EVs. We're still seeing demand for oil increase, but for the most part, it's from the non-transportation sector. So EVs are having an impact, particularly in China. That trend downwards is unlikely to continue, we think, because hybrids are probably going to be growing market share, and EVs are going to slow down, and that's not just in China, but globally. So we do see positive demand and positive demand growth, but at much, much lower rates than we would have been otherwise. So that is the problem. Demand isn't strong, and supply is coming on, and now the potential declines in the shale may be less robust than people thought because of possible hedging on the spike we've seen recently.